In this video, I want to talk about entries, and I want to show you how you can use the very small time frames to get very precise entries in the market. Now, what's important is that you do have to have an underlying directional bias. Okay, so this strategy is about entries. It's not about your directional bias. You have to have an underlying narrative of why you think a market's moving and where you think that market's going. Okay, so I'm going to take the example first of the Canadian dollar, and this is how I typically trade on the news. There are a lot of mentors who say keep away from trading news, and I agree. If you don't understand price action behavior, you don't understand how to manage risk, you don't have that level of expertise and experience behind you, then absolutely with 100% I agree that you should keep away from volatile trading days where high impact news is scheduled to be released. So I do trade the news because I know they are the days where volatility is injected on those specific days, but you do have to have a narrative. I'm going to drop down to a 15-minute chart, and I'm going to show you how I traded this news down on Friday. Okay, now the market was having a pump up, so whenever I see the market having a pump up, I expect the market to come back down to the level of where that pump started, which is right there. So when I see that, I'm looking for a reversal, and my initial target is always going to be at that low. That's my first target. Okay, now you can see that there was actually a short entry up at the highs there, okay, which I'll talk about separately, and you can see that there's a inner pump, right, and then there's a breakdown. Okay, and so you can find these short-sighted entries by just, once the market is broken, look for the gaps. Look how the market comes into a gap to continue its move down. But I'll come to that separately. For now, I want to talk about how you can get these big moves down. Okay, now this particular move down did get to our target, which was the start of the pump, which is right there. Okay, so that was a quite straightforward trade. But I want you to notice that on this move down, that there is Tuesday. So I'm going to just scrunch this chart up a little bit, and that there is Monday, right? So that there is the low of the week for this big move up, right? So when you have this move that's now underway moving down, you have a very high expectation that the market will go back down to the low of that Monday. Okay, and you can see that we've reached that. And now the very high probability trade is not the one that I just discussed. This trade from up here to down to where that pump started is over, right? But what's important to notice here is that there is Thursday. Okay, so Thursday closed without taking out that low of the week, right? So that's very important because that then gives you an idea on a Friday's trade. So that's Thursday, and Thursday comes in to our target for this move down here. But Thursday does not continue to go down and take out the low of the week, which is the ultimate target. When you have this pump up for a move down, it is with high probability that the target is the low of the week. So when you have that, you've got Thursday closing just above the high of the week, then you can, with high probability, expect Friday to then trade down into the low of the week. And if Friday has a high impact news day, well, then you want to try and ride that. If you have the expertise, the discipline, and the risk management practices and experience on your side to be able to trade that. Okay, so this is all about price action behavior. I can't teach you how to trade. That's for you to learn with your own personality, risk tolerance levels, capital, discipline. It's 90% mind rather than strategy. What I can teach you is price action behavior. So before any move down or up, there is a opportunity for institutions to get in, and that's what I want to teach you in this video. Where are the institutions getting in, and what is the signature to know where the institutions are getting in? Okay, I'm just going to take this off. Now this is the same as what I've been showing you. This here is the Thursday close. This is now Friday's trading, and this is the target low of Monday, which is the low of the week, in an already existing down move. Okay, so you need to have that narrative clearly defined. We are bearish for those reasons. Notice that whenever a market prior to the news is going to move, it will give an opposite candle, either one or consecutive candles in the opposite direction. And that is where the institutions, that's the signature that the institutions will use to get in. And it will need to be maybe 15, 30 or 45 minutes before the release of the news. So this is the news release on this day, 8:30 Friday, 10th of May. Okay. And what you want to look for is prior to that, the last up candle, which you can see is there, and it happened at 7:30 on that day. And you want the markets to go below that. Okay. And then just before the news, 15 minutes, okay, you will see that there'll be a candle that pops up. Okay, I'm going to make this bigger. That pops up into that up candle, the last up candle prior to the news. So it's not going to be easy to identify. It takes practice. So there is the last up candle, and you can see the market has started to move down. Okay, and move down again right? But then it's also retraced up into that up candle, okay? And that's where the institutions are getting in. I'm going to put a box around that, okay? So that's the candle, and you can see that prior to the news, we've traded up into that zone. Now, what you want to do is you want to kind of get a grading of that and just mark out where is 50% of the low and the high of that last up candle prior to the news release. Okay, so you've got to be nimble, right? It's going to be somewhere, but maybe it shouldn't be more than an hour prior to the news. So in that hour prior to the news, you should be able to see an up candle, right? That you should be able to see the market start to move down. This is all before the news. So this is the 8:30 candle, the candle that released that news. And before that, you can see the market starting to go down, and it's got to go below that last up candle, okay? And any retracement back up into that area of that last up close candle is where the institutions are getting short. And the best entries will be from the low of that last up candle to 50% of that range. But anywhere inside that box that I've drawn is where those institutions are getting in. And you have to have a narrative. Where's it going? Well, we've already established that the low of the week is still intact, and that would be the initial draw on where that market is headed. And that is a nice 35 pips there from entry, and you might get a bit more because typically the market will go through there to stop out anyone that may have bought on that Monday that is now taking out. Now, we can even refine this further. I've found this to be much easier on a 3-minute time frame, but you've got to be nimble, right? You've got to really know what you're looking for. Let me go back to the time zone there. So here is that same 15-minute candle. In this case, what you will do, they're all consecutive up candles, right? So you would bring this down. Let me get rid of that. You would bring your box down to the start. So this is the last set of single candle or consecutive candles, the last set of up candles prior to that move down, right? So here we've got this false move up. Now, look at what it's doing here. It's taking all of this liquidity, all these stops from anyone that may have been already short. That's what it's doing here, okay? So it's taking out anyone that may have already been short by moving up, stopping them out, okay? And then it's getting in line with the direction of the move. So here, look at this. This is at 8:18, and you've got to wait for a move below that sequence of up candles, which is now we're starting to get below there, and now you're waiting for a move back up into that range, and that's where the institutions are getting short. We can put our fib on there to mark the low and the high. There they are 50%. Okay, so between the low and 50% of that range, that's where is the optimal entry that institutions are getting in at. But anywhere inside of that box is sufficient. Your stop has to be above that high of that candle. Okay, so you've got to have a look at it. Maybe if there's a gap, but then look for a stop to put above the gap. Okay, so there's a few different things you need to think about when you're putting in your stops. Okay, on a high impact news day, you kind of want to give it enough room to fluctuate. I mean, that there is only 3 pips, so I wouldn't have a stop just 3 pips away. I'd go at least 15, 25 pips, which is plenty of room. There's plenty of room there for a 15 pip or 25 pip stop loss. Okay, so that's one example on USD CAD for a trade down. In the next video, I'm going to provide you another example on the euro. Okay.